talked about the 3 key investing concepts, let's jump into our second lesson that's directly focused on getting started investing. In this video, we're going to get really practical and talk about investment accounts, or the vehicle that is used to hold your actual investments. After we've established a firm understanding of investment accounts, in the next video, we'll talk about asset classes, the types of investments that you could actually make, and how to bring it all together and actually make those investments. So let's kick off our discussion about investment accounts. There are a few key investment accounts that you'll need to be aware of. And when I say investment account, I'm referring to a structure or a home that will hold and track your investments. It's very similar to the bank accounts that you use on a daily basis and that you're already well familiar with. Only these investment accounts hold your investments. A helpful analogy is to think of it like a shopping cart, where the shopping cart is your investment account. And there are a wide variety of investments that you could put into that shopping cart. The 4 types of investing accounts that we'll discuss are: first, your retirement account; second, an education account; third, a health savings account; and fourth, a brokerage account. The retirement account is generally the most important of these 4. It's also the most common and well known, so we'll start there. There are a few different forms that a retirement account could take. The first form that you've likely heard of before is a 401k. In the United States, a 401k is an employer-sponsored retirement account. Interestingly enough, the reason it's called a 401k is because the rules of this account are outlined in Section 401k of the tax code. How creative is that for a name? A 401k allows an employee and an employer to make contributions to an individual's retirement savings in a tax-efficient manner. It's tax-efficient because any contributions that either you as the employee or a company as the employer makes to that retirement account are made tax-free. In other words, the employee does not have to immediately pay taxes on that part of their compensation. In addition, the funds that are saved and invested in a 401k are able to grow in a tax-deferred manner. Ultimately, what this means is that you don't have to pay taxes on any money going into your 401k or any investment gains within your 401k until you pull that money out and use it. It's a pretty sweet deal. By delaying taxes on funds in your 401k, you're able to accumulate more by unleashing the full power of compounding. Now, in order to qualify for this beneficial tax treatment, there are a few rules you have to follow. The biggest rule is that you can't access that money until you're 59 and a half years old without encountering certain tax penalties. Remember, this is an investment account that's focused on retirement, and the tax benefits are structured in a way that incentivize you to save for the long run, which is totally fine with us because that's the mentality that we want to have anyway. Because of this rule, you need to keep in mind that even though the money in your 401k is yours, you don't have the same access to those funds as you would your checking account. And you shouldn't think of those funds as liquid or accessible in the same way. This is why, as you begin investing, you should first make sure that you have a 6-month emergency savings fund that can be used for any unanticipated expenses that you may experience. The other key rule for a 401k is that you are limited in the amount you can contribute each year. And right now, that limit, which, by the way, increases just a little each year, is about $20,000 annually, excluding any employer contribution. That leaves a lot of room for some significant savings to accumulate. Remember in our example with Eric, how he was saving $500 a month or $6,000 a year? And by the time he hit retirement, he was able to accumulate over $1.75 million. Well, Think about how much more money he would have had at retirement if he took full advantage of these 401k limits and saved $20,000 a year, or about $1,600 a month. Using the Excel template from video 6, you could calculate that if Eric would have invested $20,000 a year for 40 years at an 8% return, by the time he retired, those savings would have grown to more than $5.8 million, an increase of more than $4 million. That's a pretty comfortable nest egg. The final point to make about a 401k is that nearly every employer out there will offer some type of 401k match. This means that most employers will incentivize you to save for retirement by offering to match a portion of your own contributions. For example, if you save $1,000 for retirement, they'll give you an additional $1,000 and add that to your retirement account. In other words, this is free money that your employer will give you for doing what you want to be doing anyway. So make sure that you're taking full advantage of that employer contribution if it's something that's available to you. Now that we've covered the most important and common retirement account, let's briefly talk about two more retirement accounts. The second is called an individual retirement account, or an IRA. And again, I know that name is very creative. An IRA is very similar to a 401k with a few subtle but important differences. First, it isn't sponsored by an employer, so it doesn't have an employer match. An IRA is an account set up by an individual, hence the name Individual Retirement Account. An IRA has essentially the same tax benefits as a 401k, but the annual contribution limits are significantly lower, about $6,000, like our original example with Eric. Because of this, for individuals who have access to a 401k and an employer match, it's generally a good idea to first contribute to your 401k. The third type of retirement account is called a Roth IRA. A Roth IRA essentially functions the same way as a normal IRA, with the important difference being how the funds are treated for tax purposes. Like we talked about previously, when you contribute to a 401k or an IRA, you're able to deduct your contributions from your taxable income. In other words, you're able to make contributions to those accounts with tax-deferred money. And you'll pay taxes on the money when you pull it out of your account down the road when you reach retirement. A Roth IRA is treated the exact opposite for tax purposes. When you make contributions to a Roth IRA, you don't get to deduct them from your taxes. Instead, you contribute to your Roth IRA with after-tax dollars. The benefit is enjoyed on the back end when you're able to pull that money out of your Roth IRA without paying taxes later, because you already paid them on the front end. So with a Roth IRA, you never pay taxes on the investment gains, which is a pretty amazing deal. So why would a person choose to contribute to a Roth IRA versus a traditional IRA or a 401k? Well, a lot of this answer comes down to tax planning. If you're looking for a current tax deduction and are willing to defer taxes to later down the road in retirement, then you would invest through a traditional IRA. If, on the other hand, you're comfortable paying taxes now and would prefer to take the tax benefit later on, then you would invest through a Roth IRA. Okay, we've now covered the three main types of retirement accounts. And these are probably going to be the largest and most important investment accounts that you have. You can open any of these accounts with a variety of financial institutions. But some of the most common are companies you've probably heard of before, like Fidelity, Vanguard, T. Rowe Price, or Charles Schwab. How you use these accounts will depend on what's available to you and your unique facts and circumstances. I personally have all three, which may be the right answer for you as well. Let's now talk about the other main types of investment accounts. The second type of investment account that I mentioned earlier on in this video is an education account. Just as the tax rules incentivize you to save for retirement, they also incentivize you to save for and spend on education. A 529 plan is an education investing account. It functions very much like a 401k or an IRA, but the purpose of this account is to save for a future education. With a 529 plan, you get certain tax benefits on contributions and earnings. For example, some parents may start a 529 plan for their kids' college expenses before they even start grade school. How's that for planning ahead? The reason they do this is first, to start saving for those future expenses down the road, and second, because they get a current year tax write-off for setting that money aside for future education expenses. It's a win-win. With 529 plans, these benefits can vary state to state, so make sure you do some research regarding any specific rules in your state. The third type of investment account is a health savings account, or an HSA. This is an account that's intended to help you save for medical bills and is becoming increasingly more common, particularly as high deductible insurance plans are becoming increasingly more common. With rising healthcare costs and continual changes to insurance plans, it becomes more and more important for individuals and families to be able to save and plan ahead for unexpected medical bills that could otherwise present a huge financial burden. HSAs allow individuals and families to save and even invest funds that will cover future medical bills. Similar to retirement and education accounts, you're able to contribute funds in a tax-efficient manner. With an HSA, you're able to contribute funds before taxes, and as long as those funds are used to pay qualifying medical expenses, you never have to pay taxes. There's no wonder why HSAs have seen remarkable growth in recent years. The final type of investment account we'll talk about is known as a brokerage account. This is an account that you can set up with a variety of companies and banks that will provide you access to a wide array of investment alternatives. The thing to remember about a brokerage account is that there is no special tax incentive for these investment accounts, since these accounts are not earmarked for any specific use. Instead, with these accounts, you buy investments with after-tax dollars and you pay taxes on investment gains as soon as you sell the investment and realize a gain. Because these accounts are not tax incentivized, you're also not restricted to contribution limits or timelines for when you can access the funds without penalty. The flexibility of these accounts is what makes them attractive. However, if your primary goal is to save for the long run, for example, like saving for retirement, then you'll want to make sure that you first establish a retirement account and take advantage of those meaningful tax benefits and, of course, any potential employer contributions. Well, great job! We've now made it through the four main investment accounts. Retirement accounts, including the 401k, the IRA, and the Roth IRA, education accounts, the 529 plan, health savings accounts, and finally, brokerage accounts. The most important thing to remember about these accounts is that 3 of the 4 are earmarked for specific use cases, and as a result, they're given special tax treatment. These are the retirement account, the education account, and the health savings account. The final account, a brokerage account, is not necessarily earmarked for any specific purpose, and as a result does not offer any special tax advantages. This is important because taxes ultimately impact in a meaningful way the amount of money you're able to accumulate and keep in your own pocket. It's also important to remember that these accounts in and of themselves are not investments. Remember the analogy of the shopping cart. These accounts are your shopping cart. They're the vehicle that hold your investments and provide certain strategic advantages, such as tax breaks. With that being said, and now that you have an understanding of each of these investment accounts, we're ready to jump into investment options. In the next video, we'll talk all about the 4 main asset classes, or the main categories of investments that people make. and show you how you can make those investments from your investment account and see it all come together in a programmatic way. This will enable you to establish your own investing strategy by selecting your desired investments and starting to put your money to work for you. I'm looking forward to seeing you in the next video.